delight to welcome you all here to our second portion of this year's Economic Outlook Conference deliberations. I do want to underscore at this time that this conference time will be extended to 1:30, just in case we have more questions and answers than we do have time available to deal with them in 1 hour. I also want to underscore again that this meeting is being recorded. So please know that by being at this meeting, when you ask questions, those questions will be recorded, etc. I also want to emphasize that we are going to be hearing first from President Tom Barkin of the Federal Reserve, and that after that, our two economists, who many of you know, will then give presentations, and that President Barkin has kindly agreed to remain behind until the end of the event, so that even after we have taken question and answers for President Barkin, we will have a chance again to hear from President Barkin after Doug and Joey have presented their material. I'd also like to thank our sponsors, SCRA and Blue Cross and Blue Shield, and please thank you to them for their incredible support. This is the second event of this time, and this is because of the unusual things that have happened in this COVID era. And we have attendees listening to this event from Georgia, from North Carolina, and of course from South Carolina. We also have a number of students that are attending this event, some from as far as Illinois, and we look forward to presenting to such a wide audience. In our first event of this type, we had about 270 people registered, and this event is close to 300 people have registered. And I want you to know that we have people from presidents to CEOs to business leaders, from members of our communities around South Carolina. We even have a chancellor of one of our satellite campuses attending, and many members of South Carolina state and local entities are at this event. It is now finally my delight to introduce President Tom Barkin to this event. President Barkin is President and CEO of the Federal Reserve Bank of Richmond. He also serves on the Fed's chief monetary policy body, the FOMC, and he is on the ground in our Fed 5th District, covering South Carolina, North Carolina, Virginia, DC, West Virginia, and Maryland. His engagement with us over the last numbers of months and years as he's been in this position has been amazing. And I've had the honor of meeting President Barkin and listening to him in a number of events. And I don't think that there are many people in our country that have a feel for what's going on both at the national and well as at the local level than President Barkin. Fortuitously, prior to him being in this position, he was also the CFO and a senior partner at McKinsey, I think arguably the top consulting firm in the world. But even prior to this, he also served on the board of directors of the Reserve Bank of Atlanta from 2009 and 2014, and he was chair of the Federal Reserve Bank of Atlanta from 2013 to 2014. I can't think of somebody better qualified to speak with us this morning than President Barkin. Thank you for joining us, President.
Well, thank you, Peter, for that very nice introduction. And I'm glad to be here, and I regret that it has to be virtual. So, we're at the beginning of what people call the Economic Outlook Conference seasons. And I think trying to think about the economic outlook is a worthy challenge. Yogi Berra is famous for once saying, it's tough to make predictions, especially about the future. And so you should know my track record. I went back to last year where I spoke at several similar conferences and tried to answer the question that was prevalent at that time, which was, after such a lengthy upturn, is a recession around the corner? My flippant answer was that expansions don't die of old age, they die of a heart attack. Little did I know I had the wrong disease. And this shock has been unprecedented, both in human and economic proportions. So I thought today what I might do is just reflect a little bit on where we've been this year and share some perspectives on where we might be headed. These are my own thoughts, not necessarily those of the FOMC or the Federal Reserve System. And that frees me up to be as direct as I want to be. And so I'm looking forward to your questions and comments, which I think you can put into the Q&A section on your Zoom call. And as Peter said, my background's business, not research. And so I hope you're going to find some of these views and experiences relevant. So let's talk about where we've come. This year's been quite a roller coaster. Of course, in April, the economy shut down. And when that happened, spending plummeted, and so did jobs. We've talked a lot over the last few decades about the shrinking number of middle-income jobs and the growth in both the higher and lower ends. Sadly, this recession directly targeted those at the lower end of that barbell, the personal contact service workers, who tend to be disproportionately young, disproportionately women, and disproportionately people of color. As the economy reopened in May, Congress brought extraordinary fiscal stimulus to bear, and that's bridged a number of those who've been laid off. It's also led to a huge increase in our savings rate. Real personal income year to date is up a little over 3%, despite the sharpness of this downturn, because of the enhanced unemployment benefits and because of direct distributions to households. And people like me, who were able to shelter at home, found that their spending declined dramatically. And as a result, the savings rate, which is usually around 8%, was 26% in the second quarter and was still a little under 14% in October. Now, those of us with elevated savings couldn't spend on services the way we used to. So we paid down our credit cards, rotated our spending toward goods, especially those goods that related to time at home or to outdoor recreation, like furniture or home and garden or boats or RVs. Real durable goods spending is actually up 12.6% versus pre-COVID levels, while services spending is still down 6.8%. Well, with goods spending up, manufacturers have benefited from that, and I'm sure that's helped in the upstate. In October, the Richmond Fed survey of manufacturers in our district reached its highest level on record. Low rates have likely also helped. Interest-sensitive sectors like residential and automotive have been booming. Home builder confidence has hit all-time highs. Single-family housing starts are the highest they've been since before the Great Recession. You may have seen that third quarter GDP came in at a record 33.1%. That's a quarter-over-quarter number, and of course that was inflated by the steepness of the second quarter plunge. So I prefer to compare it to pre-crisis levels as a better marker for where we are. GDP is still 3.5% below where it was at the end of 2019. Within that, consumption's down 3.3%, private investment's down 2.7%, and federal government spending is up 2.6%. So that's spending. I actually think spending's coming back faster than employment. Nationwide unemployment continues to drop. In October, it went to 6.9%. And of course, South Carolina's numbers were even lower at 4.1. But as with GDP, you have to compare it to pre-crisis, when the national unemployment rate was 3.5%, and the rate here in South Carolina was 2.5%. Jobs are still down 6.6% versus pre-COVID levels. There are 10.1 million fewer jobs in this country today than there were in February. And people don't quite focus on this because the rate has come down so fast, but that's actually worse than the numbers were at the very bottom of the Great Recession, where we were down only 6.3% in jobs. So we're down 6.6% now. At the depths of the Great Recession, we're down 6.3%. What's going on there? Well, businesses are running at constrained capacity. Others are understandably cautious and have taken the opportunity to streamline their operations. And you all know leisure and hospitality employment is down a ton, 21%. Now, despite elevated unemployment, I'm still hearing from workers, especially in manufacturing, technology, and healthcare, that they can't find workers. Keep hearing from employers that they can't find workers. And some of that is due to a drop in labor force participation. It was 63% before the crisis. It's down to 61.7% today. In other words, if you kept participation constant, unemployment wouldn't be 6.9%, it would be 9.4%. Women's participation has lagged men's. You have to imagine that escalating care responsibilities at a time when childcare and schools may be closed or remote and elder care facilities are perceived to be less safe, are making it difficult to commit to work. There's also a labor market mismatch. These lower income service workers, think a bartender or a waiter, don't necessarily have the skills for the jobs that are available, I described in healthcare or manufacturing. Many are frozen in place, not yet ready to move or invest in training for their next job, given the uncertainty about the virus and perhaps their hopes that their employer will reopen pretty soon. Now, as evidence for this lack of labor mobility, look at community college enrollment. Community colleges, offer certificate programs that deliver new skills in a short period of time. But unlike four-year schools, their enrollment's down, probably due to uncertainty and challenges with childcare, lack of engagement with online schooling, or too little information about financial aid. So I mentioned uncertainty. We've been talking about uncertainty all year. But for me, and I know it may be risky to say this, I think the future has finally come into somewhat clearer focus. First, let's talk about the virus. I'd hoped it'd be behind us, but the recent escalation in cases to more than 170,000 per day versus its prior peaks of 32,000 in April and 67,000 in July make me believe we still have a way to go. Governments may well be reluctant to shut the economy down again, but consumers have the ability to do quite enough on their own. Sentiment has flattened, and while I haven't seen big impact in the real-time numbers I track, I am watching consumer spending closely. On the positive side, I expect to see a vaccine approved by year-end, giving us some daylight on the horizon. But as best as I can tell, a broad enough rollout to make us fully comfortable interacting in personal commerce again might not be until sometime this summer, at best. On the fiscal side, divided government looks quite likely to me. Many businesses like legislative stalemate and believe it promotes the certainty that supports investment. On the other hand, while there may be one more targeted stimulus to come, we seem much more likely to be revisiting fiscal prudence over the coming months. Many people ask me about inflation, but inflation's hard to find in the numbers. Over the last 10 years, it's been 1.5%. Reminder, our target is 2%. The price level actually fell slightly from February to April before rebounding strongly over the summer, especially for items in short supply, like food or lumber or cars. But it's moderated recently, and over the last 12 months, core PCE inflation remains at 1.4%. Some worry that our balance sheet and the size of our balance sheet will escalate inflation, but now that we pay interest on reserves, I don't see it as printing money. I think of it more as trading short-term debt for longer duration debt. Others worry that there's too much stimulus in the system, both monetary and fiscal. But we had the same concerns 10 years ago here, and also in Europe and Japan. I see the continuing power of technology-enabled price transparency, globalization, and professional purchasing organizations with market power as important checks on runaway inflation, as is the Fed's willingness to act if need be. So what does all this mean for 2021? I see promising signs for business investment, as I suggested earlier, supported by our accommodative forward guidance in monetary policy. You can see that in last week's strong durable goods report. In contrast, I think the spike in government spending is behind us as the country moves to divided government. The key question then is on the consumer side, which of course is 2/3 of the economy. Here we have to come back to the elevated savings rate. There's a lot of money in people's pockets, and that's cushioning the cessation of fiscal stimulus, and it could propel the economy at some point. I saw a recent estimate sizing it at $1.25 trillion and assessing that it was relatively equally held among income quartiles. The last time we saw a savings rate this high was World War II, when rationing limited spending, not unlike today. And the post-war years saw huge spikes in consumption. Could we unlock similar pent-up demand next year? Well, I certainly hope so. I see these savings more as a backstop than a stimulant. In the first half of the year, if the virus surges and fiscal stimulus ebbs, these savings will be essential to support spending, particularly for goods, and to enable the less fortunate to cope. In the second half of the year, while I do expect some post-vaccine resurgence in demand for high-end services like a good meal or a nice vacation or a business trip, services generally don't yield themselves to significant volatility. You can't make up a missed haircut or dentist appointment or vacation days. And the wealthy, who then will have most of the savings, generally take a long-term mindset on their spending. So my outlook is a slow and steady recovery, but one that has the big downsides backstopped. You might say we took the elevator down, but we're going to need to take the stairs back up. And with that, let me close and take questions and comments. And I'm happy to come back next year and report again on how I did. Thanks, Peter.
Thank you so much, President Barkin. And I think the metaphor that you ended up with, the elevator down and the stairs up, is a wonderful way for us to think about where we are going. And thank you, sir. We will take you up on your offer and invite you back next year to find out whether it was really an elevator or stairs. The first question that we have comes from an individual who asks the following. I was surprised to read that individual and corporate bankruptcies have not increased to the COVID-induced economic decline. Do you see that changing in 2021?
Well, it's a really good question. And, this situation was unique in a couple of ways. One is obvious. We actually just shut the entire economy down. But the second is that the level of fiscal that we put into the economy was just massive. And so we had a number of small businesses, think restaurants, bars, that were at severe risk in April and May. But the PPP program came and gave them a very important, fiscal backstop. We have a bunch of individuals at severe risk, but mortgage programs, rent relief programs, credit card forbearance programs, student lending forbearance programs, took a lot of that pressure off as well. And so we went down at levels that we haven't seen, I guess, since the Depression. But a lot of that depth was covered by these fiscal stimulus and by these lending and rent relief kind of programs, which gets us to 21. And so I think it's a pretty interesting question. On the business side, as I said, I'm reasonably hopeful. And, while there certainly should and will be sectoral realignment in certain industries, again, restaurants and bars being a good example, that may not have the same capacity in the future that they had in the past. I think most businesses are sort of through the bad stuff and are on the way up. On the individual side, I do worry about this. If you're someone living close to the edge and someone offers you rent relief, you're going to take it. But rent relief doesn't mean the rent goes away. It actually means that it accrues. And there are people who haven't been paying their mortgage payments or their credit card payments with the agreement of the banks, but at some point that will change. And so there's a pretty big bow wave out there for those individuals. And I do worry about how they're going to cope. And importantly, how our economy adjusts back to a level where you don't have these one-time forbearance programs. You actually have people paying as you go. So I'm watching that closely, and it is something I worry about. I will say, up to now, when I talk to the creditors, I don't hear sizable escalation in defaults or late payments just yet, but it is something I'm watching closely.
Thank you so much. And in fact, the next question relates to this from one of our attendees. Anecdotally, I have heard from a number of employers that extended unemployment benefits have caused workers to stay out of the job market. Is that supported empirically based on numbers that you have seen?
So we heard a lot about it over the summer. And when I dug into it over the summer, the conclusion that I came to was that there weren't a lot of people who were quitting their job so that they could make more money on unemployment. But people who were laid off and making more money on unemployment had a hard time convincing themselves and perhaps their family that they should come back to work, take a pay cut, if you will, and put their health or their family's health at risk. So I saw it as an asymmetric sort of thing. You still hear it now. And just a reminder, that stopped being paid in July. So I don't think there's anybody right now on unemployment who's making more money than they would have before. You do have, as I said, some excess savings, people who didn't spend or saved some of that excess, and maybe that gives people a little more cushion to be a little more selective in their job. But I don't think that's happening at a sizable rate. What I do hear from employers is, as the virus escalates, people have health fears. And I guess I understand that. And so to me, the stuff that's keeping people out of the workforce is less about being paid to be out of the workforce these days and more about concerns about their or their family's health, or concerns about how they're going to take care of their family when schools are closed or schools are remote, or you've got elderly parents who aren't in a home and you've got to take care of, that kind of making life work thing. And that's where I think the biggest tightness is coming from.
To shift gears just a little, thank you for that response. I'm going to combine two questions. Number one, does the size of the Fed balance sheet concern you and why? And second, which is obviously related to this, what is your forecast about interest rates going forward?
Well, in the second, we've given pretty explicit forward guidance, probably as explicit as I think we've ever given in our September statement, repeated in our November statement. This said rates will be low until we get to maximum unemployment and inflation hits 2% and looks like it's going to moderately overshoot 2%. We're clearly not there today, and people would have different points of view on when we get there. But as you could tell from what I said, we're pretty far from the unemployment, maximum unemployment right now. We're pretty far from target inflation, and so I think it'll still be a while. On the size of the balance sheet, markets seized up in March and early April, and I think what we did in the balance sheet was absolutely critical in making them work again. And so I think I didn't have any concerns about the size of the balance sheet there. There's no evidence at this point that a size of a balance sheet creates any other dislocations, either in markets or with banks or with inflation, as I talked about earlier. But I guess I would acknowledge that you can't grow, the trees don't grow to the sky. And so there's probably some level at which the balance sheet is so large that either we've put too many reserves in the banking system and it's not clear that the banks are willing to take them, in which case we need to address that. Or certainly we're capped at the size of the outstanding treasury market. So that's another kind of limit. So there will be some limit at some point. I just don't think we're there yet, but it is something I am trying to watch closely.
Thank you for that. Just another two questions that I can combine, and you did deal with some of this in your initial comments, but let's just get your summary from it. Do you think Congress will act to employ another round of PPP and also provide some additional assistance to the smaller community banks? And if so, how long do you think these actions will take?
At your next conference, you should have someone who's an expert on Congress. I'm certainly not that. There's clearly a window now with this Congress to try to pass something by the end of the year. And I do think the PPP is a very popular program with both parties. A lot of these unemployment insurance benefits expire at the end of the year, so there's some incentive to do something there. So there might be something there, and people have made lots of positive noises on that. But I can't tell you that I can problem solve the question of what it's going to take for the two parties to get together on this. And, they might, but they might not. In my own forecast, I've chosen not to build in additional stimulus just because I don't know that I can count on it. You'll have a new administration, and when the new administration comes in, they've certainly also put some stimulus ideas on the table, infrastructure program and those kind of things. And again, those things are going to get legislated, and they might happen or they might not. So I'd say, as I said in my talk, I've taken the highly likely stimulus out of my forecast. I'm more in a world of let's manage against where we are, and there may well be stimulus that come, and that'd be good for the economy. But I'm not planning on it.
And of course, not to state the obvious, the outcome in Georgia at the Senate level is obviously a key contingency on your comments, right?
I certainly don't know what, even though I lived in Georgia for 30 years, I couldn't predict that. But, I'd say if we do have a 50-50 Senate, I do think you've still got, challenges getting stimulus of the size that was being talked about in the early fall through. So I think that would be a challenge. But again, the legislators know better than I.
Thank you, sir. So let's switch a little bit towards local governments. And a question has been asked is, local governments have postponed capital projects. With a slow recovery, When would be a good time to resume such projects? First quarter, second quarter of 21? Question mark.
Wow, that's such a complicated question. So the first thing I have to say is that different local governments have massively different exposure to this particular downturn. If your economic structure is mainly built on property taxes, for example, you're actually not doing badly at all. Home prices are up, not down. You haven't had a collapse in commercial real estate prices either. And so your real estate tax collections actually probably aren't bad. On the other hand, if your collections are, as a local government, are restaurant taxes like Richmond's are, then you've got a real challenge. Or I talked to another community that has taken very aggressive action to not collect utilities and other sort of fees from residents through this downturn, and is now seeing a big hole in their budget because of that. And if the structure of your financials are such that you are vulnerable to that, then I think 21 will be a tougher year than 20, because a lot of the income taxes people paid in 20 were for 19 income. And so people will be paying or closing out their 20 income in 21. And so I do think there's some real challenges to the income stream more in 21 and 22, unless, of course, to your prior question, there's a stimulus program that helps with it. Mm-hmm. As to when do you do capital projects, it totally depends on your financial structure. I tend to believe when it's time to do a capital project, it's probably time to do a capital project, and then delaying them, they're usually done by borrowing. And so it's just a question of access to capital markets. And unlike, the spring, it does seem like municipal capital markets are open. And so if it's a good project that pays off, I'm not sure I would see the case to wait.
Okay, thank you so much for that. I'm going to switch gears just again. We're testing your incredible ability to answer just about everything going. What were your thoughts when oil prices plummeted to negative pricing per barrel? Do you label this a short-term supply-demand issue? And are there any global implications of this development?
Yeah, I thought that was crazy, wasn't it? So, the mega story in oil and gas, I'm sure everybody knows, which is that, the Saudis and the Russians in the early spring decided to open up the spigots, if you will. And so supply increased, and then the pandemic came and demand collapsed. And I actually think the demand collapse, whether that be, airlines or driving miles or whatever, was a much bigger driver of what's happened to oil prices in the last 6 months than the supply side. But they kind of happened right on top of each other, and so it was hard to track. My understanding is what happened after that is, and I'll speak metaphorically because I'm not saying this was exactly what happened, but you had a bunch of barges filled with oil going for delivery at a particular date, and you had a bunch of contracts that by their nature expired on a particular date. And so, think of it conceptually as, not enough berths in the port. And so you had people saying, well, I can't take that oil. And so they're actually paying people to not deliver the oil. That's effectively what happened with the negative oil prices. I think it was a one-time or a unexpected market dysfunction built by the structure of those particular agreements. It wasn't, when price went negative, it went negative for a particular date in a particular place, as opposed to saying a month later it was negative. So I don't think it was anything systemic, but it did point out to some of the issues with the structures of those instruments, which is they do require physical delivery at the end of them. And when you can't take the physical delivery, say because your tank or your oil tanks are full, then it does raise the question of how much would you pay to not have to take it. And that's what happened there, I think.
Okay, President, thank you so much. There's still 3 or 4 questions outstanding, which we do have on record, and hopefully after Doug and Joey have made their presentations, we may come back to them. Let me suggest to all attendees that any questions that are not answered, we will be looking at them and forwarding and trying to get answers to them if it is important. So thank you for that. Equally, I'm very delighted to see people are beginning to work out. There was a message up front. Q&A is coming through the question and answer sessions on the Zoom screen itself. So please make sure that you stick with that. It's now my absolute delight to introduce Joey van Nessen, who I'm sure to most attendees here does not need much introduction. The only thing that is missing on Joey's bio is that his undergraduate was at Furman and his PhD was from the University of South Carolina, and that really prepares him to understand, probably better than just about anybody alive, what's going on in South Carolina. Joey is a very, very well-known person around the region. I know that he consults with the Federal Reserve of Richmond often when they ask him questions about what's going on across our state and our region. And he also does work for Sunoco, Blue Cross Blue Shield, Michelin, Boeing, SNL, the Savannah River National Lab. I mean, it just goes on and on and on. There are few people that can advise us about what's happening in South Carolina better than Joey van Nessen. Dr. van Nessen, all yours. Unmute, Joey.
There we go. Okay. Just had to make sure my screen was sharing there. Well, good afternoon. Thank you, Pete, and good afternoon to everyone. Thank you again for that introduction. It's great to be with everyone this afternoon, and a pleasure to be here to share our outlook for South Carolina over the next few minutes this afternoon. What I'm going to do in my comments is really take stock of what's happening in South Carolina in 2020, review what we've seen this year, and provide some perspective on what we anticipate locally for 2021. And I'm not going to principally disagree with anything that President Barkin said, but I am going to extend his comments a bit, talking again more locally about what's happening right here in South Carolina. As we get started, I think it's important to really look seriously at the progress that we've made in 2020 in South Carolina, because in many respects, we can make the statement that South Carolina's economy is almost back. We've seen some very strong recovery rates throughout this year, and we've seen some improvements in a significant way. And so I want to just take stock of that and talk through some specific numbers in terms of where we've seen this recovery so far. And we can start by looking back at overall employment trends in South Carolina throughout 2020. This shows you the changes, the dramatic changes that we've seen throughout the year, and really illustrates what President Barkin mentioned about the elevator followed by the stairs, the elevator on the way down and the stairs on the way up. We see here the clear decline in employment activity between March and April of 2020, where South Carolina lost about 13% of its total workforce. That then transitioned to what we call a V-shaped recovery pattern, where we saw a rapid rebound as the economy began to reopen in May. We saw businesses come back. We saw consumer spending begin to return. And so sizable growth from basically late April and early May up through about July, where we then transitioned to the third component of this recovery in 2020, which is the U-shaped recovery pattern, which is the more slow and steady growth rates that we have seen since then, which, while slower, are more sustainable for the long run. So in sum, if we look at 2020, really three major components: the contraction due to the shutdown, followed by the V-shaped recovery pattern, followed by the U-shaped recovery pattern. And if we put all that together and take it as an aggregate and look over this last 7 months, basically what we see here is a decline in employment that we are at right now of about 4%. That is, in South Carolina overall, employment is about 4% lower than where we were pre-pandemic, so back in February. And that's a pretty strong statement in and of itself in terms of the recovery that we have seen to date. But these numbers actually look even stronger if, instead of looking at the state as a whole, we take out the leisure and hospitality sector. And if we do that, it turns out that employment in South Carolina is now down only about 2% relative to pre-pandemic levels. And this graph here really encapsulates nicely the dichotomy of this recovery that we have seen in 2020. So leisure and hospitality, which, as we all know, was the hardest hit sector in South Carolina, is still down about 17% compared to pre-COVID levels of employment. So still really struggling as of November of 2020. But when we look at all other sectors in South Carolina, we see that we are almost recovered, only down about 2% overall. And if we step back and look at South Carolina's economy and at any economy, and we think about what it fundamentally, how we fundamentally consider it, you can think about an economy as basically the buying and selling of goods and services. And so in South Carolina, we see that the goods market is doing fairly well and has seen a very strong recovery. The services market, particularly in-person services and the leisure and hospitality sector, is really struggling a bit more. And that's going to be the theme of my comments today in terms of how we're looking ahead, because the recovery as we move into 2021 in South Carolina really centers on when we see this recovery in the service sector, in leisure and hospitality, and that's going to be driven largely by the development of the vaccine. Now, if we look more locally, we see similar trends in terms of this strong recovery that we've seen overall in South Carolina, particularly outside of leisure and hospitality. We can see this if we look at unemployment rates at the county level. And here we can compare on the left side of your screen, October of 2019 to October of 2020 on the right side of the screen. And what's really interesting here, I think, is that if you look at October of 2019, you had someone that looked at that picture on the left, and then they went away for a year. You know, they fell asleep or went to space for a year and then came back, and they were just looking at these two maps. They look almost identical, right? So October 2019 and October 2020. So the unemployment distribution within South Carolina has largely returned to what we would a distribution pattern that we would expect given more normal economic circumstances. And that has just emerged in the last few months. So a lot of similarities here at the county level. Of course, the major disruption occurring during the summer months, particularly in April, and we can highlight where these major differences were. The upstate, of course, with a major decline in manufacturing during the spring months, we see high levels of unemployment there. That's unusual for South Carolina. And then, of course, due to leisure and hospitality, the cutbacks in leisure and hospitality creating high levels of unemployment along the coastal regions of South Carolina, particularly in Charleston, which you can see here in the map as well. But a fairly steady transition from October of 19 to April of 2020, and now to October of 2020. One other area where we can see significant improvement this year is if we look at the unemployment rate itself, where we've seen dramatic improvement. Again, comparing where we are today at 4.2% unemployment as of October, looking back to February of 2020, where our unemployment rate in South Carolina was 2.5%. And that at the time was a historic low. We see the sizable increase since then, of course, during April at 12.8%. But basically, we're now within 2 percentage points of that pre-recession unemployment rate. And if we take out, again, leisure and hospitality and adjust for that obvious major sector that is still struggling, we get an unemployment rate that's even closer to being comparable to where we were back in February. So that adjusted rate closer to 2.7%. Now, we have seen some reductions in the labor force in recent months, and that does affect these numbers slightly. But overall, if we compare the labor force levels, the number of people in the labor force in South Carolina in terms of where we are today versus where we are back in February, those numbers are fairly comparable. So this is, I think, a fair comparison in terms of the unemployment rates in terms of where we are today versus where we were back in February. Now, extending on this theme a little bit further, looking at the differences, the dichotomy of the recovery that we've seen in 2020, again, comparing the goods market versus the services market, who has recovered and who hasn't. If we just look at some of these trends, very clearly you can see the major differences in some of the sectors of the economy. So at the US level, we can look at personal consumption for durable goods and just compare where we are today versus where we were 1 year ago. You can see durable goods consumption is up compared to 1 year ago. The same picture is true if we look at non-durable goods. So very, very similar trends overall. And that translates into significant recovery for the Charleston port and cargo volume that's coming through the port of Charleston this year. So here we can look at changes in terms of year over year growth rates for exports and also import activity. And when we look at these two numbers together and basically aggregate it up, what we're seeing is we're at about 1% lower right now than we were this time last year in terms of total container volume overall. So again, the goods market, manufacturing coming back has led to positive changes for the Charleston port as well. And then that's very different from looking at personal consumption on the services side. Here we see the anomaly, again, as we've alluded to before. So this is the one sector where we still see consumption significantly below where we were this time last year. Again, just comparing the goods industry or the goods sector and the services sector for the U.S. economy and for South Carolina in particular. And one area of South Carolina regionally where we really see this playing out is if we compare the upstate compared to and compare it to the rest of South Carolina. So I showed you before how during the height of the shutdown, manufacturing was hit pretty hard, and we saw high rates of unemployment in the upstate. But now the opposite is actually true. If we look at the different major metropolitan regions in South Carolina, as you see here, turns out Greenville is the only one that has seen full employment recovery so far. So that's great news for Greenville, great news for the upstate more generally. And why is that the case? It's because Greenville and the upstate is the most manufacturing-centric region of South Carolina, a very goods-intensive economy compared to elsewhere, Columbia and Charleston, for example, that are more service-based sectors. So this composition of the industries that are driving the recovery that we have seen this year is having very different ramifications depending on the region of South Carolina that we look at in terms of where we are in November of 2020. All right, so that's a look back and summarizes the growth trends that we've seen so far this year. And again, just reiterating that our economy is coming back strong. Leisure and hospitality sector, the obvious caveat there, still struggling. But if we divide the economy into the goods sector and the services sector, we can really see where our strengths are right now and where we still have some work to do going into the new year. So now let's talk about 2021 in terms of where we are headed next. We do see more economic headwinds coming in the next several months, but a double-dip recession in 2021, very unlikely. Going forwards, we hear about a double-dip recession from the most pessimistic forecasts, but that's not something that we see going into 2021. But I do want to come back and talk a bit about these economic headwinds that we are concerned about in a bit more detail. There are three of them that I want to briefly address. The first is the end of the moratoriums, particularly the foreclosure moratoriums that look like they will end on December 31st before 2021. And that, of course, is going to create some additional strain on housing markets. But residential housing has had a great year, as President Barkin already mentioned. That's been true in South Carolina as well. And the demand being driven largely by low inventory levels and also by low interest rates, that is likely to continue into 2021. So even though the end of the moratoriums will potentially increase inventory levels and again put some brakes on the growth that housing has seen this year, I still think 2021 is going to continue to be a strong year, and we're going to continue to see strong demand for housing overall. But the end of the moratoriums is a concern and certainly a headwind that we need to be monitoring very closely. Another headwind that we're anticipating, of course, as you are all familiar with, is the increases in the COVID-19 cases and the end of the emergency unemployment insurance, a third headwind there. And these last two really tie back into leisure and hospitality in South Carolina and really help us to frame and to think about what the pace of recovery will look like next year. Because again, South Carolina, with most other major industry sectors largely recovered, has to really look at leisure and hospitality as being the sector that needs arguably the most assistance right now. And that's going to continue to be the case as COVID cases go up over the holiday season. We continue to see impacts on consumer, or are likely to see impacts on consumer confidence, their willingness to go out, frequent bars and restaurants, and that is going to be a reality going forward. So for the next few months, this increase in cases is certainly going to provide another headwind for leisure and hospitality in particular. Also, it's likely to further increase unemployment. And if we look at the total number of people in South Carolina currently on emergency unemployment benefits, many of them, a bulk of them, are actually workers that used to be in leisure and hospitality. So these last two concerns are, again, very much related and tied back into the leisure and hospitality sector. And the end of the emergency unemployment insurance that will expire again on December 31st will affect about 130,000 South Carolinians who will lose benefits immediately beginning in 2021, which creates about $130 million worth of federal dollars that were coming into South Carolina and that would be spent that will not be beginning in 2021. So again, not a trivial number, and something that we have to keep in mind in terms of looking at what these long-run implications will be as we move into the new year. So we can actually see these COVID cases themselves. Of course, the third wave you can see from a national perspective already, where we've reached that new peak. And these are 14-day rolling averages that you'll see. And then if we look at South Carolina cases, we haven't reached that third wave just yet, but we're getting close. And South Carolina, in many respects, follows these national trends. So we anticipate those COVID cases going up. So this will be a concern throughout the holiday season and going into January, into the new year. And then one other element I alluded to before was looking at the unemployment insurance claims, but looking at initial claims is important as well, because as we anticipate continued layoff activity in leisure and hospitality as COVID cases rise, that's going to be another drag on the rate of recovery that we are likely to see. And initial unemployment insurance claims is a good way to specifically quantify that. Even though we've seen a dramatic decline in the layoff activity all year, this graph goes back to July 4th, so you can see the sizable decrease and the significant improvement. We also need to recognize that initial unemployment insurance claims, so layoff activity, is still about 65% higher than it was pre-COVID back in February. So we still see layoff activity that is elevated overall. Again, that's largely in the leisure and hospitality sector, but we expect that this may tick upwards in the coming weeks and months, again, as COVID cases rise and as the leisure and hospitality sector continues to be affected. Now, that's the negative side, the negative piece. The positive side is that even though this third wave of cases is upon us and will be continuing going forward, to some extent we have a template for how to think about this, because we did see a significant increase in cases back in July. And notwithstanding the leisure and hospitality sector, if we look at the goods markets and other sectors of South Carolina's economy, and to a lesser extent to the national level as well, consumer confidence, it of course went down significantly between March and April, but has stayed somewhat consistent since then. So it really has leveled off a bit. And if we look at retail sales activity, those have continued to climb since the summer, despite the fact that we've seen this increase in COVID cases already. And I think this points to a broader trend, which is that even though we will see some pullback as COVID cases rise, it's also true that businesses and consumers have adapted. They are expecting this, they're anticipating it. Businesses recognize the importance of keeping their customers safe and have changed their business practices accordingly to the extent that they can. And consumers are prepared for this as well. And so that shock value just isn't there the way it was back in the summer, or even back the way it was in the spring. So I don't think we're going to see a pullback as much as we have previously, particularly when we move away from the in-person services and the leisure and hospitality sector more generally as we move ahead. A couple of other comments quickly about South Carolina. I think one element that's important to talk about in light of one of the questions to President Barkin before was looking at the fiscal health of some of the different states. And South Carolina in particular, we're actually looking pretty good here. This is certainly one of our strong suits this year. If we go back to February and we look at what the Revenue and Fiscal Affairs Office was forecasting for the general fund revenue, about $10 billion for the 2021 fiscal year. That's then since been downgraded 2 times. But even with that downgrade, they're still anticipating that the general funds will be higher for the fiscal year 2021 than it was for fiscal year 2020. So again, we are in very good shape fiscally in South Carolina. You can also see here the last bullet point, South Carolina has an $811 million one-time surplus. So we're in pretty good shape, and that's very different from many other states. Now, the county level numbers may look a little bit different. Again, each county is going to be collecting their tax revenue from different sources. So your mileage may vary a little bit at the local level, but South Carolina as a whole, our fiscal health is looking strong, and that is a nice add-on to the fact that the economy overall, again, with the caveat of leisure and hospitality, has recovered quite nicely in 2020. So our specific outlook for 2021, as you can see here, we have a range of forecasts this year. So we have really an upper and a lower bound, or a more pessimistic and a more optimistic scenario based on the different possibilities, the different likely possibilities for the vaccine. When does it become widely available and accessible? And the bottom line here is that our optimistic projection suggests that we are not likely to see full employment recovery in South Carolina. That is, getting back to employment levels that we were at in February of this year until sometime during the third quarter of 2021. That is our optimistic projection at this point. It may be well into 2022, but again, this is more biology driven than it is economics at this point, particularly in South Carolina. When does the vaccine become available? When does it become widely accessible? And that is what is going to restore consumer confidence and help to restore and reboot the leisure and hospitality sector. So it really is about biology at this point, but based on the current projections, these are our estimates for South Carolina in 2021 and moving ahead. So the bottom line, just summing up, South Carolina has experienced a strong rebound, as you can see here, throughout the summer and fall months of 2020. Most major sectors are approaching pre-recession employment levels. So we have had a strong recovery this year. And Greenville is the best example of that. It's been the recipient of a lot of this recovery. Again, the first and only so far major metropolitan region to see full employment recovery in 2020. And of course, the primary exception to this strong recovery is leisure and hospitality, which is still down about 17% and simply can't recover until we see a vaccine available. So that's very closely tied to the biology. The increases in the COVID cases over the winter months and the holidays will put further strain on leisure and hospitality. So we anticipate some setbacks in the short run, and additional business closings as well. I think that one of the unfortunate consequences here has been the closing of a number of significant iconic businesses, both in the Midlands and Columbia and throughout South Carolina. And unfortunately, I don't think we've seen the end of that. That is likely to, we're going to see more announcements like that, I'm afraid, at least for the short run, for the next several months, again, as we get through the winter months. But looking further ahead into 2021, as we mentioned before, a double dip recession, unlikely, but full employment recovery in South Carolina right now, likely looking to be during the second half of 2021 during the third quarter. So I will stop there. Thank you very much for your attention. And I'm now going to turn it over to our director of our Division of Research, Dr. Doug Woodward, and he's going to talk a bit more about the long-term economic consequences of the pandemic for South Carolina's economy.
Doug, you can go ahead. I was going to introduce you, but Joey kind of precluded that wonderful introduction. Let me just say that Dr. Woodward has been at the school since the mid-80s. He's participated in the vast majority of these EOC Outlook conferences. Equally, he is well quoted around our country, and he has made presentations to international events like Davos. And he's going to be talking more about the national and the longer term than just the South Carolinian circumstance. All yours, Doug. Thanks.
Well, thank you, Pete. It's a pleasure to be with you all today. And I just want to remind you that we're going to take more questions for Tom Barkin and for Joey Van Nessen and for me after 1 o'clock. So we're going to run past 1 o'clock, at least till 1:30. And so keep your questions coming on the Q&A function on Zoom here. You know, many of you were with us back in late September when we had our first Economic Outlook Conference for this season. That was our pre-election Outlook Conference. And you can see now, listening to Joey, how much more optimistic we are going into 2021. A lot has changed. President Barkin talked about this being a roller coaster year, and it sure was. I remember back in March and April, the feeling in the pit of my stomach as we were riding that roller coaster down. But now we're coming back up, feeling much more confident about the shape of the economy and the position we're in here, especially in South Carolina, going forward into 2021. What I want to do briefly is talk about something big. What are the long-term economic changes we can expect in this post-COVID economy that we hope to see start taking shape in the next year? I want to talk about some mega trends here. We've been talking so far about the short-term economic outlook. I want to look more at the long-term, pre-COVID BC versus after COVID AC. I want to address some national and international shifts that I see taking place and the implications of these trends for South Carolina. There's three major trends that I see have resulted from this pandemic economy. The first is having to do with government, the massive amount of monetary and fiscal stimulus we've been talking about. We talked about it in the last Economic Outlook Conference. President Barkin was talking about it today. Huge amount of debt expansion from the government. I want to address this. Another trend is having to do with globalization, supply chains, what's going on with trade. Also, I want to address what's happening with China and what's happening elsewhere in the world. So there's a lot to cover. But there's a third major trend I want to address too, and that has to do with regional migration. Remote work, everyone knows, is a major trend towards that, and the potential for an urban exodus. So these are the three trends I want to talk about as I see are major structural changes happening in our economy. First mega trend, government is back and it's bigger than ever. If you go back to before COVID, and even if you go back to the last recession, 2008, 2009, we were coming out of it, people weren't so confident that government was the answer. Yeah, I remember Ronald Reagan once saying, government is the problem, not the solution. And that ideology, that way of thinking still persisted into this century and was a way of thinking and was actively being debated even 10 years ago. There was a idea that we should starve the beast, that we needed austerity, even as we were in a recession. And at that time, we also had a very hawkish monetary policy still in place. There were people on the Federal Reserve Board who believed that we had to raise interest rates and keep a rein on the money supply to forestall inflation. Now, after COVID, it seems like this is no longer being debated. There's growing government, federal government is going into debt. There's an exploding amount of public debt. We had the unprecedented amount of stimulus. I talked about it in my remarks in September, fiscal stimulus that was to the tune of the CARES Act of $3 trillion, not billion, but $1 trillion. In addition to the fiscal stimulus, we've had this incredible monetary expansion, a very dovish monetary policy that we know is going to persist now for at least a couple of years. We've never had anything like that before, where there's this consensus around that government is the solution, both with monetary policy and fiscal policy. This is a major change. I've been doing this for 33 years, but I've never seen such a consensus around government. Federal government is the answer, both the Federal Reserve as well as the Treasury and the programs that Congress puts in place, like the CARES Act. And these are big programs. Here's what the Fed has been doing. I won't go into the details here, but I just want to show you the trend here. Low interest rates. This is the effective funds rate that the Federal Reserve targets, and they expect this to be a zero interest rate policy for the next few years. No talk about raising interest rates. As you can see those bars there with the recessions, when they raise interest rates, it tends to, the bars represent recessions, they tend to slow down economic activity, but we don't see that happening. It's not in the cards. This is not what the Federal Reserve is telling us. And then you can see, and this question came up in the Q&A for President Barkin, the expansion of the Fed's balance sheet, which is really the expansion of liquidity in the economy. I talked about that last time in September, but you can see we're talking about upwards of $3-4 trillion of new money in the economy. So this has never happened at this extent before. And there's very little debate about whether this is effective or not. Everyone believes that this has been a large part of the reason that we've been able to recover so well this year, and much better than we have in past recessions. So low rates, massive liquidity. Now, there's a lot of concern about this. This is not only happening in the United States, this is expansion of the money supply or liquidity, but it's going on around the world. So there could be the tsunami coming. Everybody Everybody's, again, they're worried about inflation that could happen in the future and what could happen to the value of the dollar. If we are expanding our monetary base faster than the rest of the world, that's going to depreciate the dollar. In fact, it has been doing that. That's a trend a lot of people haven't been noticing, but the dollar's down considerably relative to most major currencies right now. That can be a problem if it keeps going on in the future. That will require our central bank to have to raise interest rates to try to shore up the value of the dollar, as has happened in past depreciations of our currency. But it's not going to happen in 2021, I'm pretty sure. So the tsunami is not coming. Don't worry. It's something we have to worry about long term, though, just not in the short term. What about government here in South Carolina? Well, Joe was talking about this, so I want to spend a lot of time on what happens at state governments, because we can't print money here in South Carolina or other states. We have to balance our budget, and a lot of state budgets are going into deficit. By law, they're not allowed to keep that in deficit, so they have to find funding. And through 2022, states are facing about over $400 billion in increasing deficit. The states that are looking to be in the worst shape right now are Nevada, Louisiana, Illinois, and Florida. That has to do with the balance of taxes that they have, whether they're dependent on sales tax versus property tax versus income taxes. We have a balanced tax system here. The rest of these states are going to require more stimulus from Washington to get them to balance their budgets. As Dr. Von Nessen was pointing out earlier, South Carolina is in relatively good shape right now. So we're not as dependent on the government to come in and bail us out right now. But other states are going to be asking for that as the Biden administration takes hold in January. Okay, mega trend number 2. What about the urban exodus? Before COVID, in the last expansion from 2009 through 2019, a lot of the economic activity was in the major coastal cities like New York, Boston, Washington on the East Coast, San Francisco, Seattle on the West Coast. We call these the superstar cities. That's where a considerable amount of GDP growth was taking place. Lagging regions in the interior parts of the country. We had these developing urban talent hubs with higher density and concentration of economic activity in the major urban areas. Post-COVID, the trend we can already see is this movement to remote work. And I think this is a serious long-term trend. It's going to continue to happen. There's going to be a dispersion, not just of firm activity, but of talent across this country. And that's going to favor lower density cities, of which we have in South Carolina. Greenville, Columbia, the area below Charlotte, Rock Hill, Charleston are lower density than these major superstar cities. This is going to work to our advantage as we see more and more of an urban exodus, because people are looking for space to be able to work at home and a quality of life that they can find in lower density cities. Here's what's happening with migration. This is the pattern 2010 through 2019. South Carolina did, this is before the pandemic, obviously, but South Carolina did particularly well during this time in terms of net migration from other states. We are in the second to top quintile in positive in-migration of all states, about 414,000 people coming into our state from other states. We were up there with other southeastern states, not quite as high as the in-migration into Florida or Texas, Washington state. But if you see the lighter colors, Illinois, New York, and the lighter blue in the central part of the country, these are states that are actually net out migrants, losing population. We are gaining. So we're in good shape before the COVID crisis and the move towards more remote work. And I think we will continue to see that trend. In fact, it may even accelerate. We're getting lots of migrants from North Carolina, actually. They're coming across the border, particularly around Rock Hill, but into South Carolina. North Carolina is picking up a lot of people coming in from New York. So is Florida. I think we'll start to see that trend as well. More and more people come from other states. So we're in really good shape given this mega trend of migration that's taking place and will probably accelerate post-COVID. The third mega trend I want to address is global trade and globalization. It's back on track. There was a lot of concern about it as we entered into the crisis in early 2020. So before COVID, what we had was a trade war. Remember that? We had economic nationalism under President Trump. And with COVID, we had this idea that there would be more localization, there'd be more production moving back into the United States, particularly from Asia. Remember, that's where COVID started. Well, after COVID, it looks like globalization is here to stay. Globalization is enduring. There's been very few supply disruptions from Asia and from other supply chains outside of our borders. And this has been a big surprise. Trade has held up very well. And that bodes well for South Carolina because we're a trade-oriented state. The real winner in this pandemic is, ironically, China. This is where the pandemic started, but their global shipments now are defying expectations. Their trade surplus, despite the trade war, despite the pandemic, has widened. There's strong demand for Chinese exports and other Asian exports as well. Some production has moved out of China to other Asian export platforms like Vietnam, Taiwan, Korea. Even India has picked up an Apple iPhone factory recently, but China is still doing very, very well and is turning out to be a winner in this post-COVID period. Here you can see how they're pulling ahead. They're the only major economy that is growing right now. The rest of us, well, we're growing, but we're still below where we were in 2019. We're coming back. We're seeing this V-shaped recovery. You can see for the United States, the Euro area, we're doing better than the Euro area. In Mexico and India is still falling in terms of GDP, but not China. It went down considerably early in 2020 and bounced back and is growing about 5%. For them, that's actually pretty slow, but they're back in a recovery mode, doing extremely well. So they're a winner in the global growth marathon to date. I just want to make one other comment about China. It's not just that they're doing well with goods and exports, which is their traditional competitive strength, but they're now moving into software, into apps. Do you know that the most downloaded app during this COVID period is not Zoom? It's actually TikTok. Billions of videos now viewed daily in the United States. These are videos, this is an app that targets our youth, using it extensively. The mission of TikTok is to inspire creativity and bring joy. And apparently this is what our youth are doing in this otherwise unjoyful time during the lockdown. But they've been putting out all these TikTok videos. You probably are familiar with that. That's a Chinese app. Now, President Trump didn't like that and wanted to ban TikTok from the United States. And then the TikTok influencers, the stars, started complaining about this. Then they shopped around for a buyer in the United States. Oddly, it was Oracle and Walmart trying to put together a deal to buy this Chinese software company. But the real lesson that we learned from this is China is actually getting very good at software too. In fact, it's AI that's driving TikTok. They used AI to learn about habits in China and consumer habits and what makes people become addicted to these apps. And then they brought that platform to the United States and it just took off very rapidly. But the point is they're getting very good at AI, not just at selling goods, but now it's selling software and apps here in the United States as well as around the world. So what about South Carolina? That's about China. What about South Carolina and global trade? Well, Dr. Von Nessen mentioned that container terminal volume is down just slightly at 1% compared to last November, year over year. That's actually quite incredible. Usually in a recession, we see double-digit declines in trade. That's what we saw in the last, and that persists for a year or two after we go into recovery. We're barely down at all. In fact, it looks like we're going to be up pretty soon in container volume in South Carolina. So trade volume is reemerging faster than previous recessions. Our auto exports and supply chain related to that doing particularly well. Inland ports, an investment that we made over the last 10 years in South Carolina, are also growing in volume. A lot of this is in the autos and supply chain, but increasingly we're seeing more retail demand fueling import growth. And that's an opportunity for our ports, South Carolina ports, and the logistics and distribution industry, which is looking very promising as we enter into this post-pandemic economy. So we're doing very well with international trade. We're not seeing a lot of international investment coming in right now, but trade volumes are growing and doing better than in any previous period in looking at previous recessions. So let me just summarize these long-term prospects then. We're seeing the federal government growing by leaps and bounds in an unprecedented way. South Carolina, on the other hand, is very good fiscal health. Very, very surprising because this was not the case in previous recessions. In terms of migration dynamics, South Carolina is benefiting from the work at home. I think it will continue to do so. We're seeing in migration. So this bodes very well for our state's population growth. Finally, globalization, which we're tied to, is alive and well. It looks like the trade war is over. And as we come out of this, South Carolina is a winner. So those are my overall long-term, what I see as the long-term prospects for our state related to these mega trends. I look forward to your questions. I thank you and wish you all a happy holiday. But with that, I'd like to now turn it over to Pete to monitor our questions. We have a lot of them coming in, and we got plenty of time to answer them for you. Okay, Pete?
Thank you so much, Doug. And it seems to me like to continue the metaphor that President Barkin started us off with. We have a couple of stairs to climb, but South Carolina seems to be fitter than the average state to be able to climb those stairs, and that the medium-term outlook is not as bad as we had expected, I suspect 6 or 7 months ago, which is all good news. We have a couple of questions that are more technical in nature, dealing with the role of the Fed, President Barkin. And if you don't mind, I think we will just put those into a packet and perhaps send them to you, given the constricted time that we have. But may I just say that we had a couple of questions around the currency. One was directed to you, President Barkin, about will we have a strong dollar next year? And then Doug, of course, you got into the stuff about the dollar. So can I ask Doug to start off, what do you think of the value of the dollar in the medium term? And then Tom, if you want to just, round that off at the end. Go ahead, Dr. Woodward.
Well, forecasting currencies is one of the most difficult forecasts you can make. But I will say this: I think the dollar will continue to see depreciation because our amount of monetary expansion relative to the rest of the world is greater. It's been more stimulative. There might be more coming. So I think the dollar is going to continue to depreciate, and it's one of the concerns we have to have, especially. I want to hear what President Barkin has to say about this, because when currencies depreciate too much, it can cause a lot of disruptions. It's inflationary, for example, because the cost of imports goes up, and then it gives more pricing power to domestic businesses as well. So it's a potential problem for inflation. The way the Fed central bank usually combats a depreciating dollar is by raising interest rates. But that's exactly what we don't want to see right now. So it's a big concern. I don't think it's going to be a dramatic drop from here, but we have seen considerable decline. And I think in 2021, that's going to continue to be the case. President
Barkin, go ahead.
Well, I totally agree with Doug that I don't know how to project currency movements. So I think humility is good on that. Certainly relative interest rates is important for currency value. And we had a very large gap at the beginning of the year. It's now a smaller gap. It's hard for me to come up with a case that gap's going to move meaningfully over the next period of time. What will move meaningfully over the next period of time is how each of our economies comes back from this virus. And so the question of the strength or not of our economy, the question of the strength or not of their economy, to me, is the most important thing I would look at for the next 12 to 18 months. And I guess despite all that we see about case escalation and viruses, I still think our economy has a lot more upside potential than the European economy does, both the vibrancy of our economic model, but also, the European economies are relatively hamstrung in terms of what they can do from a stimulus standpoint. And to the extent we would need it, I think we still have capacity. So, there has been the shift that Doug talked about, but I guess I think going forward, I'd look much closer at the relative strengths of the economy and where you project them going over the next 18 months.
I just quickly add to that, though, that I agree about Europe, but Asia, as I'm saying, is coming back very strongly. As I think you see a lot of growth in Asia right there.
No, that's right.
Might bode well for emerging markets.
That's very fair.
I would just add a slight attenuation that one questioner asked. Do you think that there's likely to have another currency that arises as the means of exchange and replacement of the dollar in the future? And if so, should we be concerned about that?
Maybe I'll start. The dollar has hegemony for a number of reasons. The stability of the system, which we lead in the world, the liquidity of the instrument, the rule of law in the country, and a strong belief that the U.S. will always stand behind it. You'd hate to have anything change any of those. A debt ceiling kind of thing would be the sort of thing that, would make you nervous. But I think it is clear that the rest of the world isn't that excited about the U.S. dollar having the strength, the reserve currency role that it does. Mark Carney gave a speech, who's the head of the central bank of the UK at the time, gave a speech at Jackson Hole a year and a half ago, basically saying the world needs another currency. And the reason why he was saying that was, I think there was some discomfort over our ability to leverage our currency into things like sanctions. Our ability to prevent European governments from dealing with Iran being an example of that. So the question to me is not whether the rest of the world would like one. The question is, what would it be? And, you'd have to believe a lot of positive stuff about the euro and the strength of that network to support that, the health of the economy in Japan, the rule of law in China. So it's just not that clear what the replacement would be. But I think there is certainly desire for there to be an alternative.
I just add that I completely agree with that. There is no alternative to the dollar. We saw that in the pandemic when everyone was concerned back in March and April. They rushed to the dollar. There's nowhere else to go. It's not the yen. It's not the euro. It's certainly not the Chinese renminbi. Those currencies are trivial compared to the reserve holdings of dollars around the world and the vehicle currency role that the dollar plays. It'll take decades, I think, for the dollar to be replaced. It's not going to happen in the short term. I do believe there's concern, like Tom Barkin said, that there is too much weight put on the dollar as a vehicle currency and as a reserve currency, but there just isn't anything else out there, and it's not going to be Bitcoin either. So I'll just leave it with that.
Doug, I would just add to summarize, it sounds like we fall into the cleanest dirty shirt syndrome at the moment with regard to currencies, and that it's going to be a long term before we get into that adjustment, but an important question. Can I then switch just a little, because President Barkin, this question came up under your review, but I knew that Doug was going to cover this. The question was, how will the WFH, which is the work from home migration, affect the overall economy, and specifically the economy in the southeastern United States? Now, Doug, you did deal with that, but do you want to add anything? And President Barkin, do you want to add any other thoughts on the WFH migration?
Doug, why don't you go ahead?
I think Pete said I already covered it, so if you wanted you to get your remarks.
No, look, I think the thing you always have to be careful about is, does this fundamentally change the world, or is this a new arrow in our quiver? And, I'm reminded after 9/11 when my colleagues thought we would never travel again, but 2 years later, everybody was on planes. And so for sure, we've learned that we can be flexible in terms of work from home. And I think that has a lot of positive value for people raising kids, or having other kinds of issues at home. And I think that's very good. But, I'm still, I think, a believer that we're not going to, 3 years from now, be at full-time work from home across all of our various entities. I think if you want to build a culture and an institution, personal contact matters. I think humans are social creatures and want to have that interaction. And so I see work from home more as a flexibility enabler than I do as a sea change. And I could easily be wrong on that if we're in virus conditions 3 years from now, that I'm clearly wrong on that. If it is that, then I think you will see you will still see impact. You'll see, like we're seeing right now, people investing in and focusing on their house, because if you're going to work from home, your home matters more. Certainly, when I talk to people in Hilton Head or Kiowa or other beach communities, I think people are buying second houses and even first houses in more resort locations. So I think all of that will happen, but you just have to test yourself on whether this is an enhancement or whether this is a sea change. And I think we're still a ways from knowing that.
Okay, thank you for those two answers. Just to switch gears just a little, we've had a few questions more related to what's happening in South Carolina. And Joey, I'd like to involve you on this. The first one was, obviously people of color have been the hardest hit or among the hardest hit in the current recession. Do you have any forecasts per categories in those domains for South Carolina, and what do you see over the coming future? And add to that issues with regard to the corridor of shame, economic growth, healthcare, all the stuff that is related to that for this community.
I think first, if we look at the areas that have been hardest hit, and we look at the demographics of that workforce, we know that in South Carolina, as with the nation more generally, it has been younger workers. So in South Carolina, we see workers under 35 primarily affected, and then the workers affected that are unemployed far more likely to be female. And we can see that specifically if we look at the unemployment insurance claims data, where normally in South Carolina, it's about a 50-50 split. So if you look at the number of people claiming unemployment benefits, it's about a 50-50 split between men and women. In 2020, it's been between 55 and 60% women. So which is a pretty significant change from what we normally see. So that's been the biggest evidence where we can observe that. And that's in sharp contrast to what we saw in the aftermath of the 2008 recession, just to put that in context, where it was the exact opposite. It was actually men who were more likely to be unemployed. And that has to do with the composition of the workforce. Of course, last time around in 2008, it was the construction industry, which tends to be more male dominated. And then this time with leisure and hospitality, which tends to be more female dominated. So those are the two trends that where the data are very obvious at the local level in South Carolina. And regarding the corridor of shame and other infrastructure and projects we have to think about long-term in South Carolina, I would say in the immediate future, broadband access is critical. South Carolina really has to get out ahead on this in order to take advantage of these immigration trends that we've heard mentioned in a number of different ways. But that's an opportunity for South Carolina. So to the extent that we do see more people moving in state, we see people working from home, obviously broadband is necessary for that to flourish. And then also for establishing equal opportunity going forward, to the extent, again, that work from home or virtual schooling, all of that, as that continues, broadband access becomes key to maintaining equal opportunity. So I would say that's a critical next step for South Carolina.
President Barkin and Doug, do you have anything to add on Joe's response?
I just say South Carolina unemployment is quite low, and it has been quite low. South Carolina workforce participation is actually below the national average. And of course, if you break that down by the cities versus the smaller towns, it's totally driven by the smaller towns. And you mentioned the corridor. It's all those small communities that really don't have people in the workforce. So I just think it's a need, it's an imperative. It's why our bank has pivoted aggressively to working on the issues of smaller towns, because and in South Carolina, obviously they're very strongly minority, those smaller towns. And so what can happen in those smaller towns to actually get those folks into the workforce and with all the benefits that come from that.
I'll just say too, yes, this is a significant long-term challenge for our state. The corridor of shame are the counties that are inland, not on the coast, running up along near I-95, as everybody knows, and they face education and infrastructure challenges that predated COVID, and they will continue to be the major economic development challenges we face going forward, with very high unemployment rates, no matter what the cycle of the economy is doing. As President Barkin alluded to, a lot of people not in the workforce. This is a tough thing to turn around. But the size of the population relative to the cities is actually very small. So you're not talking about a large segment of our population, but it is the most challenging economic development problem because it persisted before this crisis and it will continue to afterwards.
So, gentlemen, it sounds to me like your responses all are, let's not let this crisis go to waste. And we should use it as an impetus to try and get to the healthcare inequities and the educational inequities that are, across these areas of our state. And of course, that needs the political will to make it happen. There is a related question that has been asked, and Joey, I'll let you start this and then we'll move off from there. We know why Charleston is now lagging because of their hospitality leisure, but so is Columbia. And one of our attendees has asked that Columbia's economy has underperformed for almost the last decade. So how do you explain the underperformance, both currently as well as over the last decade, for Columbia relative to the other two metros?
Well, in 2020, Columbia is underperforming. It's performing closer to the state average, in that the reason we haven't seen full recovery here is simply because we don't have as strong of a manufacturing base, certainly when compared to Greenville, and we are more of a service economy. And services extend beyond leisure and hospitality. You can think of all sorts of in-person services that are part of any metropolitan region. If we look at healthcare, that's one other area where we have not seen full recovery yet. And particularly, if you look at, again, non-emergency healthcare related services, Columbia has if you look at the distribution of employment in Columbia, that's another piece as well. And then the other major component of Columbia, of course, is the government, where we haven't really seen any appreciable improvement since the decline back in March and April. So all those are at play. We are a service economy, but the lack of recovery of the government and the public sector is the primary culprit for what's going on in Columbia right now. And getting into the long run implications of Columbia and why we haven't seen growth, I think Dr. Woodward, maybe you want to start with that and talking about echoing on your comments about some of these long-term trends and growing the Midlands region.
Yes, that's right. There's been a lot of discussion in the county, in the city, about why we're lagging even before this crisis. Over the last 10 years, we didn't grow at the same rate as Greenville and Charleston. We were attracting the professional jobs we would expect in a university town like this. So there's a lot of awareness about this. There's been studies that have recently been completed about where we can be more competitive in fintech, for example, and try to build new clusters. We really don't have any strong clusters. We have something going in insurance, and a lot of people are aware of that. We want to build on that in the future. But this is a major challenge. The other thing I'll say, there's a recent report that was put out about our fiscal situation, our high taxes in Richland County in particular, relative to other places in South Carolina, that deters businesses coming in here and also deters residents coming in. So other parts of our state are seeing population growth, are seeing home values appreciate, so their tax base is growing. That's not happening in South Carolina. So we have to keep these high taxes on the existing population, and that's really holding us back. And so we're not seeing the kind of business activity. So we need a fundamental revamping of our tax system. Part of the reason we have these high taxes too is we have higher costs for government and for schools, administrative costs relative to Charleston and Greenville. And that's becoming well known, and it's deterring business activity right here. So we've got a major issue having to do with taxes that we're going to have to address before we can see us start to catch up to where we should be, given everything else that's positive happening in South Carolina.
Thank you for that, Doug. And I'm afraid we've only probably got time for one or two more questions if we're going to stick to the 1:30 time limit. President Barkin, there was a question under your presentation that's come up again under the later two. Janet Yellen, what's the impact of her appointment on the administration of President Biden, fiscal policy, etc.? Your views on that, and then Doug and Joey, you may add in following that. Go ahead, President.
Well, Janet was the chair when I took my job, so I know Janet, and she's a very capable leader, a very capable public servant. I'm sure she'll do a great job.
Go ahead, Doug.
I'll just give her an endorsement. She's an economist, a PhD, a professor, former professor, very well respected within the economics profession. She's taking over from a Treasury Secretary who actually had experience in Hollywood, but her experience is in academia. Hopefully that will be put to good work. She's probably one of the best people you could have for that job right now.
And I don't have anything to add to that, except she's extremely qualified and I think a good choice. So I would just agree with the comments that have been said already.
And Doug, if I could just draw you out just a little bit further, a stronger fiscal policy / governmental interventionism. Do you think she is likely to be for that, against that, neutral? Any ideas on that? Given your
She's a Keynesian. She's it for fiscal expansion. Well, in the last recession, she had some comments. She was sounding like she was sort of pro austerity, but like I said, nobody believes that anymore. I think she's going to be for as much fiscal stimulus as it takes to get us to full employment. That's going to be her main objective.
All right. Well, in some ways, I'm delighted to tell you that we've almost come to the last question. And though I hate to end on this particular note, it's been asked by a couple of people. Bitcoin has reached a high recently, and we heard you, Doug, say that you didn't think it was a credible reserve currency. Do you want to just expand on that? And President Barkin, if you have anything to say about those sorts of developments in the monetary arena.
Yeah, I don't think Bitcoin really plays all the functions of money. I don't want to get into my full lecture on that right now, but it's not going to replace the dollar. First of all, you can't pay your taxes with Bitcoin. You're always going to need dollars. So it has some limits. I think it's mostly a speculative play right now. The stock market boomed, so people were looking for someplace else to go. It didn't go into gold. Now it's going into Bitcoin. We've seen it can run up, it can go back down. But this is what you want to do if you want to speculate. Bitcoin is where you want to be right now. But that serving the role of a really fully functioning currency, I sincerely doubt that'll ever happen.
President Barkin, any thoughts?
Well, I'll say that the number of questions I get about Bitcoin is directly correlated with the value of Bitcoin at any particular moment. So, as you said, it is elevated. The guy I've talked to who had the best insight on it said, if you were in a place where you didn't trust your currency, then we should have a conversation. If you were in Argentina or maybe Turkey, then something that has a stable store of value might be interesting. And of course, that's the dollar plays that in a lot of those places. But in the US, I'm not sure why you would use something that the government doesn't. You would take something where you don't know who stands behind it in favor of something where the government stands behind it. It just doesn't make any sense to me. So I would agree very much with Doug on that.
All right, and I'm going to use chairperson's prerogative for one more question, which just came through, and Joey, it's to go to you. Not much mention of Horry County in our presentations today. Our attendee believes that Horry County is the second fastest growing county in South Carolina. And although a lot of hospitality is involved there, this county is a prime example of the urban flight that I think Professor Woodward talked about. Any insight into this area for our attendee?
Yes, so that's exactly right. It has been growing very, very fast, and despite the fact that it had the highest unemployment rate in the state back in April, it has largely rebounded, and construction has been doing fabulously well in 2020. And I think that is a region that is going to continue to grow. It also has a second homes market there, so it is going to benefit greatly from these in-migration trends, and also from retirees coming to South Carolina as well. So I agree that Horry County is going to be the beneficiary of these in-migration trends going forward, and that's going to continue for the foreseeable future.
And with that, may I thank President Barkin for joining us here today and for spending an hour and a half with us. Thank you for your incredible service. And please keep our economy going in the way that you've managed to do so for the last while. And equally, Doug, can I thank you and Joey for your incredible support to our state, to our university, to all our communities around here. It's an absolute joy for me to always have events like this and work with you. May I thank the almost 150 attendees that are still online here today for attending this event. I wish you all a safe and festive holiday season. Please don't let your guards down now, and we look forward to reconvening with you sometime in the new year at our next event at the Moore School. Bless you all. Thank you for your attendance.